Welcome to The Explainer. Today, we are diving into a really powerful framework from the legendary investor Howard Marks. He basically splits the entire investing world into two camps. You've got those who think they can predict the future and those who know they can't. So let's break down which one of those actually gives you an edge. So at the very heart of Howard Marks' whole philosophy is this simple, but honestly pretty profound idea. Every single investor, whether they know it or not, belongs to one of two schools. First, you've got the I know school. These are the folks who believe they can forecast the economy, pick the next big stock, time the market just right. Then you have the I don't know school, and that's where Marks puts himself. This group works on a completely different principle. The future is basically unknowable, so the real goal isn't to predict it, it's to prepare for it. All right, let's start with that I know school. Its central belief is that you can reliably predict all the big macro stuff. Interest rates, GDP growth, where inflation is headed. And look, it's a really tempting idea, right? But as Marks argues, it's a pretty dangerous illusion. Marks loves this quote from the economist John Kenneth Galbraith, and you can totally see why. It just perfectly captures the whole world of macro forecasting. It's a field that's absolutely filled with people who aren't just consistently wrong, but are also supremely confident in their flawed predictions. So why is this so hard? We have the smartest people in the world, we have supercomputers, why can't we get it right? Well, it really just comes down to a nearly infinite number of variables, and they're all interacting with each other in completely unpredictable ways. And seriously, this is just a tiny, tiny sample of what's at play. To get a forecast right, you don't just have to predict how each of these things will turn out, you have to predict how they're all going to influence each other. Think about it. A geopolitical event can cause an energy price spike, which then totally changes consumer spending habits, which then forces a central bank to change its policy. It is a chaotic system, and pretending you've got it all figured out, well, that's the first big mistake. Okay, so if prediction is just a fool's errand, what does the I don't know school actually rely on? Well, instead of forecasting, they focus on a much more powerful tool, understanding where we are in the market cycle. And Marks illustrates this with his brilliant idea of the market's pendulum. Marks uses this fantastic metaphor of a pendulum. He says that investor sentiment is almost never rational or stable. It is always swinging toward one emotional extreme or the other, from that greed-fueled euphoria where everyone thinks things can only get better, all the way over to that fear-driven panic where it feels like the world is ending. That happy medium in the middle where prices are actually fair, that's just a point the pendulum swings right through on its way to the next extreme. So here's the crucial point. You don't need to predict exactly when the market is going to turn. You just need to have a really good sense of where you are right now. Is the collective mood closer to euphoria or is it closer to despair? Just answering that one question tells you a whole lot about whether it's a time for caution or a time for aggression. And this path right here shows you exactly how that cycle plays out. The real money, the smart money, is made in stage one, when things still look pretty grim, but a few contrarian thinkers see a little glimmer of hope. By the time we get to stage 3, the party is in full swing, everyone is wildly optimistic, and guess what? All the bargains are long gone. This old saying just summarizes the whole concept perfectly, doesn't it? The greatest returns are made by buying what absolutely no one else wants and selling what everyone is desperately clamoring for. It's a simple idea, but actually doing it, well, that is emotionally very, very difficult. Okay, this leads us to another huge disagreement between the two schools, and it's all about the definition of a single word, risk. Because how you define that one word changes absolutely everything about how you invest. So the I know school and a lot of the academic world, they define risk as volatility. They measure how much a stock price bounces around. So a stock that has these huge price swings is considered risky, and one that's pretty stable is considered safe. But Marks argues that this is a dangerously flawed way of looking at it. For him, risk is way simpler and a whole lot more important. It's the chance you will lose your money and never ever get it back. And reframing it like this is absolutely critical. Think about it, if you own a piece of a great business and its stock price falls 30% just because of a market-wide panic, have you actually lost money? Well, not permanently, not unless you sell. In fact, that price drop has made the asset less risky to buy because you're getting the exact same business for a much cheaper price. Volatility can actually be your friend. And here we have the great paradox of investing. Real risk is at its absolute highest when everyone is complacent. When people truly believe that prices can only go up, that's when they take on way too much leverage, that's when they pay foolish prices. That euphoria, that widespread belief that there is no risk, that is precisely what creates it.
Okay, so if we accept that the future is unknowable, that cycles matter way more than forecasts, and that real risk is about losing money for good, how do we actually put all of this into practice? Well, Marx says the key is to develop what he calls second-level thinking.
So first-level thinking is simple, it's superficial, it stops at the first most obvious conclusion. But second-level thinking is way more complex. It always asks, and then what? It considers not just the company itself, but what everyone else thinks about that company, and whether that popular view is already baked into the price. Look, anyone can master first-level thinking. The really superior returns, though, are reserved only for those who can operate at the second level. So how do you actually practice it? You have to internalize this entire I don't know mindset. You have to constantly ask yourself, am I just following the herd here? Do I really have a sense of where we are in the pendulum swing? Am I focused on avoiding a permanent loss of my money, or am I just worried about some temporary price wiggles? It's all about building a framework that relies on these durable concepts, not on flimsy predictions.
Ultimately, it really all comes down to this. If you want superior results, you have to have a superior process. And a superior process, by its very definition, has to be different from what everyone else is doing. If you just follow the crowd, you are absolutely guaranteed to get an average result, at best.
And that's really the final challenge that Marx leaves us with. Truly great investing, it's not about finding comfort and safety in what everyone else thinks. It's about having the analytical rigor, and more importantly, the emotional discipline to stand apart from the crowd, knowing that the greatest opportunities are almost always found where nobody else is even looking.